Peter Thiel has just dumped his entire NVidia stake, along with 76% of his Tesla shares. Michael Berry, who's short against the housing market during the 2008 financial crisis, inspired the movie The Big Short, currently has an entire portfolio made up of short positions in NVidia and Palantir. Investors are spooked, and they're wondering if the AI bubble is about to burst. Let me tell you a quick story about bubbles. The year is 1998. The internet is in its early days. New, exciting internet companies are emerging. Investors are pumping in money in a frenzy. People invest thousands and thousands, and the stock prices keep going up and up. What could go wrong? In early 2000, the dot-com bubble burst. The Nasdaq, which tracks the biggest US tech companies on the stock market, fell nearly 80%. Bill Gates lost $1.8 billion in 1 week, and 52% of internet companies went out of business. Investors weren't wrong in thinking that the internet was going to define the coming decades, but their overconfidence still created one of the biggest investment bubbles anyone had ever seen. Fast forward to present day, and it looks like the same thing might be happening again. The AI bubble could be about to burst. Why do I think this? There are 3 big forces at play here. Let me take you through them one by one. 1. The battle for AI dominance. Did you know that there are currently only 7 companies propping up the stock market? They're known by investors as the Magnificent Seven. These 7 companies are Microsoft, Meta, Alphabet, who run Google, Amazon, Tesla, Apple, and NVidia. These 7 companies make up a whopping 37% of the entire S&P 500, which is the top 500 publicly traded companies in the US. These 7 companies are all racing to become the leader in AI, investing billions and billions to try to achieve that goal. These billions trickle down through the rest of the S&P 500 and the rest of the economy as a whole, being spent on anything from AI chip manufacture to large-scale infrastructure. Ever heard about Meta's plan to build nuclear power plants to power their AI data centers? That's just one example of this massive interlinking AI economy. Next year, these companies are projected to spend a total of $330 billion on AI, a staggering amount that's bigger than the GDP of many countries. So, is this the 4th industrial revolution, or is it a bubble that's about to burst? You might have noticed that despite everyone talking about inflation and a cost of living crisis, the stock market is actually doing pretty well. That's because the AI spending from the Magnificent Seven companies is propping it up. In fact, without this spending, the US would probably already be in a recession. But is this going to carry on? Well, it's projected that by 2026, global AI spending will reach $500 billion. The spending on power and resources for AI is expected to reach $3 trillion per year by 2030. So, why are these companies willing to stake it all on AI? They're betting on an automation revolution. It's estimated that at least 60% of jobs will be affected by AI in the coming years, meaning that whoever controls the AI controls the totality of its economic power. It's almost like an arms race. But here's the catch. It's not just companies competing in the AI arms race, it's countries as well. In 2017, Vladimir Putin famously said, "The one who becomes the leader in AI will be the ruler of the world." That's why all the world's superpowers, and especially the US and China, are competing to become the leaders in AI. There are 2 possible scenarios in the near future. Either AI will deliver on its promise and continue propping up the stock market as the technology becomes more and more ubiquitous, or the technology won't develop as fast as expected, and as companies and countries continue to pour in billions without seeing the financial reward they expect, investors could start to pull the plug. This brings us on to the second big force, the AI economy circular loop. You see, These companies are recording huge amounts of revenue, but all is not quite what it seems. The different companies in the AI space, Microsoft, NVidia, other players like OpenAI and Intel, are all basically passing money between each other as part of a closed system. Here's how it works. If OpenAI gives Microsoft $58 billion to use their data centers, and Microsoft gives NVIDIA the same amount to buy their chips, and then NVIDIA then invests that back into OpenAI, then each company can record $58 billion in revenue despite not actually making a profit. But the stock price rises regardless, because they can technically say they've made $58 billion in revenue. The true king of this closed system is NVIDIA. Since Chat GPT launched in November 2022, their share price has rocketed up a colossal 1,600%. That's because they sell their AI chips to everyone in the market. They then invest this money back into the other companies. It's almost like paying your customers to buy your product, and it could be creating artificial demand for its chips. That's why a company like OpenAI is trading at 40 times its revenue, having a valuation of $500 billion and a revenue of just $12 billion. Have you noticed that its product, Chat GPT, which has revolutionized the world, is free, and its page doesn't feature any ads? How is OpenAI making enough money to justify its massive investments and ridiculous stock price? The game plan for these companies could be to try to get the world completely dependent on their AI products. And then, once they're hooked, they start charging big prices. And that strategy could pay off big time. So then, why would the bubble burst? Number 3, the AI data wall. AI has been improving at an unbelievable speed. You only need to look at AI-generated videos from 1 or 2 years ago and compare them with now to see how massive these improvements have been. But there's something coming up in the future that could put that progress to an end. It's called the data wall. Have you heard about data being the new gold? Well, that's because AI is trained on data. Up till now, AI models have been trained on all the human-generated data that's available. So that's every book, every piece of research, every article, every single thing that's ever been written or created and put on the internet. But it's predicted that by 2027, it will have consumed every piece of human-generated data there is. That could see progress start to slow down. And you guessed it, the bursting of the AI bubble. If progress stalls, investors could start pulling out their money. Scaling past the data wall is feasibly possible. It would be a question of transitioning AI models to start learning from synthetic data. Synthetic data is data that's artificially generated rather than collected from real-world events or people. It's created using algorithms, simulations, or machine learning models to mimic the patterns and statistical properties of real data. It's yet to be seen whether or not this will work. So, here's the trillion-dollar question. Is this a bubble? Well, I think it is. When I take into account the overvaluation of certain companies, the potential problems with scaling, the revenues not reflecting profits, and the general geopolitical landscape, I think this is likely a bubble that's going to burst. However, what I don't know is when the bubble will burst. And that's not to say that I don't think AI is a revolutionary technology. It almost certainly is. But just like with the dot-com bubble, transformative technology does not equal immunity to bubbles. And just a reminder, I'm not a financial advisor, and this is not financial advice. You should always do your own research and come to your own conclusions. I would continue to invest. We could still be closer to the start of the bubble than to the end. And the prices could continue to rise astronomically in the coming years. By investing the same amount every month in low-cost index funds that track the overall market, over time you will ride out any upturns or downturns, and your investments will likely trend upwards over a long enough time span. History shows that the market always bounces back, so as long as you don't try to be too clever and time the market, you're likely to be okay. Make sure your portfolio is well diversified. You don't want all your investments in one sector, region or technology. If you spread your assets across stocks, bonds, gold, real estate, crypto, you should be able to ride out any downturns. Thanks for watching. If you have any questions, whack them in the comments and I'll aim to get back to you. See you on the next one.